like to call the tip of the week. So this is I'm excited to be able to share this one, and actually every week that I get to share this, I'm excited to be able to share these different tips with you guys, because they are the things that I think are the foundation of why we get together and why we have a real estate investor association. It is to share tribal knowledge. It is to go together. It is to grow together. And it is to make sure that none of us make mistakes in the process, right? So if you guys are looking for a tribe that helps you do that, then it's certainly here as part of Texas REIAs. And every week we get to share a new tip. So if you guys would like to see some of our prior tips of the week, again, you can just check out our YouTube channel. Just when you go to YouTube, you can just search for Texas REIAs. Again, I can't tell you how to invest in any other state other than Texas. Some of the things I'll talk about tonight might be applicable in other states, but it is all definitely applicable here. So again, we live here, we work here, we invest here. So the things I'm going to share with you will be very focused on things that we need to know here in Texas. So if for those of you guys who are joining us online, again, hello. And I'm going to try and toggle this camera really quickly to see if I can show all of you guys that are here. So if you guys will wave, like with your arms. Oh, good. Okay. Yeah, there we go. Okay. Yeah, that's how that works. So if you guys will wave, thank you guys. Appreciate that. So someone's just going like this. So, okay. Yeah, you don't have to wave. He's like, I'm going to throw up a gang sign, but I'm not going to wave. Okay. We can do that too. So yes, thank you for the double wave. You're making up for his gang sign. So this is wonderful. All right. Wonderful. Good. So, all right. I think we're back. So I want to let all of you guys who are online with us know that you can join us anytime in person. If you want to check out our schedule, you can just head on over to TexasREIAs, REIAS.com/live. And as we go through the tip of the week, I'm curious to ask the question, are any of you guys here because you are feeling like you're suffering under someone else's glass ceiling and not able to grow as a real estate investor? Okay, one of you. Two of you are taking pictures, so it looks like you kind of have your hands up. I can't tell. Okay. So a couple you are. So, and I'll tell you, I had that impression too, because I spent a little bit of time in corporate America after I finished my education. And I felt like I was very much bumping up against a glass ceiling. And I felt like me working in corporate America, even though that was how I was socialized, right? Go to work, go to school, right? Get a good education, and then go to work, get a good job, right? That's how I was socialized. And, at that time I thought, well, I'm going to retire. And, I'm sure we put all of our numbers in the 401k retirement calculator to figure out how rich we're going to be, right? And then the market kind of goes like this. And then you have to get a defibrillator to kind of be brought back to life. And then, of course, you're working your tail off for someone else, right? And I mean, I don't want to say that someone else is evil, right? Because we're all entrepreneurs, every single one of us in this room, and hopefully every single one of us will be employing someone else at some point. It's not that we're evil; it's just part of it. But is it true that your employers are probably making a little bit more money than you, right? Now they are taking a lot of risks, so I don't want to take that away from them, but they are paying you what the market says the average version of you is worth, right? So for us as real estate investors, I feel like a lot of people get into investing because they want to get past that glass ceiling, because they don't want to be held down, because they don't want to feel like their income is limited, right? How many of you guys feel that way, right? Yeah, it's okay. It's good. Now, this is where tribal knowledge and really understanding real estate and real estate investing comes from. So let me ask you guys a question. About how many houses does it take for someone to feel what I'll call financially free, where they feel like they're just collecting mailbox money, they can go and sit on a beach, they don't have to do anything anymore? How many properties is that? It's specific to that person and where that beach is located, right? If it's Galveston Beach, okay, that's one thing. If it is, if you can call that a beach, if it is Miami Beach, right, something totally different. Well, I'll say on average for people in San Antonio, what it looks like to be able to get enough mailbox money to, be making $10,000 to $20,000 a month is somewhere between 20 and 40 properties, somewhere between 20 and 40 properties to be able to get enough mailbox money. And the reason is because initially, as you're starting to get mailbox money, a lot of that mailbox money is going where? To pay for the mortgage, right? Because you're typically not buying them all cash, at least not when you get started. So it's going to the mortgage, it's going to property management, it's going to property taxes, it's going to maintenance, repairs, it's going not to you, right? So it typically takes a period of about 20 years, and it typically takes most people in the San Antonio market somewhere between 20 and 40 houses. In the Austin market, it might be somewhere between 10 and 20 houses, just because the values are higher there. And the Dallas and Dallas, Fort Worth, and Houston markets, it's typically somewhere between 20 and 30 houses, right? Again, just because of where the values are there. So how many of you guys think that's achievable? Okay, good. How many of you guys have ever tried to get a bank loan for any house? Any house, okay. How many of you guys had to submit your 3rd grade report card to be able to get that? Yes, yes. Well, what happens when you become a real estate investor? What happens when, any lenders in the room? I'm curious. Any lenders in the room? They're like, I'm not coming to this meeting because she's talking about the investor glass ceiling. She's going to say something bad about a lender. I'm not going to say anything bad about lenders. I'm going to say maybe a little bit bad about some banks, okay? Or not, it's some of the rules and how they apply to us as real estate investors. So you guys said that you have some rental properties, yes? Do you mind if I ask how many? One apiece, okay. Anybody have more than like 4? Anybody have more than about 4 properties? Okay, one person. So typically once you get above 4 properties, even if you have great income, even if you have great credit, even if you have wonderful payment history, even if you have really high net worth, what does the lender say when you want to get the 5th one? Typically, you get capped at somewhere between 4 and 10 properties. You might be able to get to 10, but it's kind of like a fool's errand. So it's basically, if you can also walk on water, I'd be happy to give you 10 loans. But most people are stopped around 4 loans. 4 loans? That's it? Yes. Where did I tell you you want to be here in San Antonio in order to get to that 20 to 40? 20 to 40 houses. So did you guys know you have a glass ceiling as a real estate investor? You probably didn't walk in here thinking you thought, oh, this is unlimited. There's unlimited fix and flips, right? But you're not going to get unlimited loans from a bank at low interest rates. Typically, you are capped at somewhere between 4 and 10. So how are you going to get to where you want to go as a real estate investor after you get that many? You're just going to wait and save for 3 to 5 years to buy the next one cash? Say again? Private investors, and they'll give you a 3% interest rate loan, right? No. So how are you going to cash flow on like an 8 to 10 to 12% interest rate loan? It's going to be very difficult. It's going to be very difficult, right? You won't be, that's not something that's sustainable. Ask anyone who started investing in 2008 and were getting loans that were 7 or 8% interest rates, right? It was hard to sustain it through there because the properties weren't going up in value, right? They weren't doing their job, which was to make you rich. They stopped doing that for about 5 years where they were just basically flat. So what do we do as real estate investors? I thought I was getting into this because there was no ceiling. I thought the sky's the limit, right? What do you do? Creative funding. So one of the things that we learned very early on in our investing is how to buy subject to the existing financing. How to buy subject to the existing financing. And this is what allowed us to buy as many properties as we wanted to, right? To not have a limit. Now, you will find other limits as you have been investing for a long time. And one of those limits that affects us here in Texas is something called the DSR. What's that stand for? DSCR? Debt Service Coverage Ratio. Yes. This is my nemesis. Okay. This is my nemesis. This is the nemesis of every person who owns rental property in Texas that is doubling and doubling in value. Why is that? Because they want that debt service coverage ratio to be at a certain amount, but with the property taxes that we pay here in Texas, it's really hard to get there. So even when you get a bunch of properties, right, and you're like, well, I've got enough properties to get a commercial loan on all of my residential rental properties, a lot of times what you find is because they've doubled and doubled in value, you can't pull out as much money as you would like. Gosh, I'm going to cry. I need a tissue. Somebody help me. That sounds terrible, right? I know what you guys are thinking. You guys are thinking, I know she said it wasn't the get rich quick presentation, but she didn't tell us it was going to be depressing. But I'm going to give you the workaround for it. So I'm not just someone who's going to say, no to everything, but I'm going to give you the workaround for it. And that is to buy properties subject to the existing financing. So essentially you're finding a seller who will sell you their house. So there's the deed of trust, right? There's the general warranty deed, and there's the promissory note. So the person who owns the house is the one who has that general warranty deed, okay? Then there's the promissory note and the deed of trust. This is what you would sign to a Bank of America, Wells Fargo, Chase, Citi, etc. So if they got their loan through Chase, as an example, and I bought their house and I bought it subject to, meaning I kept their loan in place, that general warranty deed would transfer to me. That note would stay in their name. I would be paying that note. How many properties does that allow me to buy before a bank stops me? Unlimited, as many as you want. So what I want to get across to you guys is don't try and use all of your own cash. Leverage the cash that someone else has already put into one of these properties so that you can buy more properties, so you can be sitting on a beach faster and a better beach, right? So get to know this strategy. This is the strategy that has allowed us to way surpass that investor glass ceiling to be able to buy more, because you see a lot of new investors who get their first couple of properties and say, this is fantastic. And then they hit up against that glass ceiling and they're like, I don't know what I can do from here. I thought this real estate investing thing was really going to work. And as it turns out, I can't buy anymore to be able to build my passive income, for those of you guys who are looking for passive income, or to build my wealth, for those of you guys who have owned rental properties for a while and have seen those values double and double and double. I don't know about you guys, but for me, I want as many of those as I absolutely possibly can get. That's why I said I have the Bluebell ice cream investing philosophy, right? We eat all we can, we keep all we can, we sell the rest. So that's what I want you guys to be aware of when you are buying properties. Every time you buy a property, you need to be asking the question, can I get it subject to the existing financing? Because you want to keep your powder dry for the ones that you cannot get subject to the existing financing. Does that help you guys? I know you were not probably expecting that, but that's a little tribal knowledge I wanted to share with you guys, what we call it as part of our tip of the week. If you want to see some of these other tips of the week, again, just join us on our YouTube channel. We give new tips of the week, and we've got all the old presentations from probably the last, 8 or more years out there.